Okay, everybody. I had a question, proposed to me. It was more of a bet than anything else. Does 5% fixed beat the S&P 500 for the last 2 decades? Okay, so we're talking 2 decades, and this is always point A to point B, the path least taken, all these things. There's going to be conversations about this, which is better. It depends on which dates you pick. All right. But let's just talk about the last 2 decades. The first decade, 2000 to 2010, was a bumpy road. Some people call it the lost decade. Okay, and you'll see it. Okay, the lost decade included 9/11, 3 double-digit years in a row down in the market. It included 2008, one giant down year in the stock market, and then the rest were pretty darn good up years. But that's 4 bad years out of 10. And believe it or not, that's a lot of bad years. That's not normal, because the next decade, from 2010 to 2020, went straight up. You look at the chart of the S&P 500, we had a little bump in the road at the end of 2018. Other than that, it went straight up. All right. There wasn't really any big turbulence. Any turbulence that we had disappeared fairly quickly, because after that 2018, we rallied and had a fantastic year in 2019. And that little bump in the road, although scary when we were in it, it was brief, very, very brief. All right. So have you thought about it? Does 5% beat the S&P 500? Any bets? Anybody want to make any bets? Dangerous betting with me on that one, because I can win that bet every way we go. So here's how we're going to look at it. I've got the S&P 500's results there from 2020 all the way to 2022. So I've got a couple bonus years on there. All right. And I recognize that's a little more than 2 decades, but we can look at the numbers on the 2 decade mark at the end of 2020. So I want us to look at these numbers, start off with 3 bad years, then a few good years, and then 2008's bad year. I actually started out with just the index returns. Then I went through and added in all of the dividends. So I have total return here, including dividends. These numbers represent total returns for the years. Okay. And then you have 5% every year. All right. So I think this is interesting, because interest rates skyrocketed over the last year. And I say skyrocket, let's keep it relevant. We're still extremely low. It's relative to the last 20 years. Interest rates went up very quickly, and now we have access to 5% fixed. And that's why this conversation happened. Do I really want to sit in the market when I think 5% has actually beat the market over the last 20 years? That's what really happened. And so the argument ensued, and I pulled out my spreadsheets. Because I'm a spreadsheet geek and I love it. I don't have a problem with it. I can spreadsheet anything. I'm the son of an engineer, and I grew up with an engineer brain. So I overanalyze things. So here we go. There's your results. And the winner actually is the S&P 500. By that much. You look at 2020, the amount of money starting with $100,000 investment in 2020, in 2000, starting with 100,000. In 2020, you would have had $313,000, whereas 5% fixed would have only had 278. So the S&P 500 won, but just by a little bit. Okay. Then the last 2 years, we had a great year in 2021. Most of you probably, if you were brave enough to stay in the market through that pandemic, reap the benefits of 2021. And then 2022 has been a bit of a mess, right? For a lot of people that never got out of their bonds, not only did their safe investments lose 20%, so did their stocks. So that pulled us back to 307. The 5% is at 307, and the S&P is now at 324 in terms of the value of that $100,000 investment in the year 2000, which seems like so long ago for some weird reason. I don't know. So there's your answer. But there's a big caveat to this. All right. I work with a lot of people either heading into retirement or in retirement. So what if you retired in 2000? The year 2000, if you retired and started pulling money out of your portfolio, which was better, the S&P 500 or 5% fixed? Well, more is better, right? I have the returns right here. 23 years, the compound average of the S&P 500 equaled 5.25%, which is obviously better than 5, right? It's the compound average return, 5.25%. The simple interest equal is 9.75%, which beats 5% compound, which only equals 9% simple interest return. What does all this mean? Well, nothing. I'm asking a question. Is it the same if we start pulling out? So here we are. I'm going to choose to pull out 6,000 every single year. Okay. So we're going to do it from the S&P 500, the $100,000 investment in 2000, 6,000 out every single year, the 5% annual return, 6,000 out every single year. Okay. Here it goes. Holy cow. Now, here's where the argument begins. Is 5% better than the S&P 500? The answer is yes, if you're pulling money out of your portfolio. This is the craziest thing. Our brains don't work this way. Better is better, right? Better returns equals better results. No, that's not true. What? That doesn't make sense to me. Well, it has to, because as you enter retirement and you start taking from your portfolio, if you don't learn this the easy way by paying attention and learning math, then you're going to learn it the hard way and run out of money. And that's what people did. If you had retired in the year 2000 and relied on the stock market solely to fund your retirement, you ran out of money. Or you stopped spending so you didn't run out of money. You were not able to enjoy the retirement the way you thought you could, because the combination of 9/11 and 2008 destroyed your portfolio, and you can't keep pulling from that because you're digging into a deeper and deeper and deeper hole. I do a lot of videos on things like sequence of returns. Who needs safe investments? 5% fixed blew away the stock market if you took $1 from your portfolio. I assure you of that. When you start taking money out of your portfolio, you're changing the math. That 5.25 compound, that 9.75 simple, those numbers cease to exist by pulling 1 penny out of that portfolio because you changed the math. And that is so important to understand. And this is why people need safe investments. Okay? A lot of people want safe investments, but there are some people that need safe investments. And those people are the people that are pulling from their portfolio. And I know it hurts your brain to think that a boring, safe investment that just, you know, I want to earn 26% when the market's up 26%. 5% beats that. And that doesn't feel right, right? It's the adrenaline rush that makes your account go to zero when you start withdrawing. So build your wealth in the stock market, but don't rely on it to withdraw from it. Please, please. This is so important. Any big turbulence in your portfolio, the safe, stable stuff will save you in retirement. Nobody wants to run out of money in retirement, and nobody wants to live in fear of relying on that stock market to survive in retirement. Okay? Safe and stable when you're pulling out. Leave it all in the stock market when you're building wealth. Just keep putting in through the turbulence, and you will come out of it with more money at the end. All right? Hopefully that taught you a few things. It's a bit of an eye-opener for a lot of people. If you tried to bet with me, if you commented below, I already won the bet because I was right both ways. All right. So lots of videos on this stuff. Keep coming back. We've got 4 or 5 videos every single week, or 3, 4 videos every single week. Subscribe to the page. Make sure you keep updated on what's going on. We got lots of full classes we teach, February is tax planning month, so we got lots of tax planning videos coming out as well. Shoot us an email, give us a call. We're available nationwide via Zoom. We can meet in person in Arizona anytime you want, but we got lots of clients all over the world now and are always happy to jump in and help out whenever, wherever we can. Give us a call, shoot us an email. We'll see you next week.